we were showing on the slide a moment ago when we were looking at the portfolios. All right, but if we consider our individual stocks, then they can respond differently to this notion of market risk. And that's what something referred to as the capital asset pricing model, CAPM, is trying to show. So what it does is links the expected return from a share or the expected return from a stock to the expected return for the market. So simplest way to think about that, even though again there's a debate or an argument, simplest way to think about it is in terms of some notion of a market portfolio. Again, it's a simplification, but when people tend to use this approach, that market portfolio might be the Standard & Poor's 500 or the FTSE 100. So that's the kind of notion that people have in mind when they talk about the market portfolio. But as I said, there are kind of theoretical arguments to say it's more complicated than that. And I guess it goes back to the point being made at the back, what about other sorts of assets? So maybe it's not quite that simple, but it is the easiest way to think about it. The market is just a combination of all the shares within the market. And this is a little equation that shows you that link between the expected return on an individual share and the expected return on our market portfolio. And a little hiccup in my presentation perhaps, but I hope you forgive me. So, letters get used all over the place to represent different things. So a little bit ago I was using I to represent the interest rate. Now I represents the individual stock or the individual share. Okay, slight hiccup, sorry. So that is the return for stock I or share I. And what we're saying is that relates partly to the risk-free rate of return, but then also it relates to market return. So here we have the expected return on the market. And as you can see in this equation here, nothing else. So what it's saying is the only thing that determines expected return for a particular stock or share is its relationship to market return. And that relationship is signified by that figure there. So that notion of beta, which again some of you might have heard of. So the notion would be that it is beta that determines the relationship between expected return on the market and the expected return on an individual share. And what it's actually showing us, as you can see here, is the sensitivity of that individual's stock return in relation to movements in the overall market. So a low figure here, a low figure for beta, would suggest not very sensitive. A high figure for beta would suggest sensitive to movements in the overall market. And in a second, I've got a little picture to show you what I mean by high and low values. But just first, slightly different way of representing the same idea, slightly different phrase, will be in a second, a slightly different phrase that you sometimes come across. So, notion would be this idea of a risk premium. So, in excess of the risk-free rate. So there's our risk-free rate. In the examples that I used, 5%. And no standard deviation, so no risk. And here is how much above. So our expected return minus the risk-free rate would be this notion of a risk premium. And so, intuitively it makes sense. This is the premium you need in order to carry the risk. If you don't get any premium, then you might as well not carry any risk. You might as well just go for the risk-free asset here. Take the 5%. So a slightly different way in which you can see the same idea presented. But the principle is the same. There's our beta, and it's showing how the risk premium for a particular stock relates to the risk premium for the market as a whole. And here, another little picture to indicate what I mean by high and low betas. So, starting point perhaps is in between. Suggestion there, a value of beta equal to 1. What that means is the individual stock or the individual share bears exactly the same risk characteristics as the overall market. So it's just as risky. And the little M there is trying to illustrate that to say this would be the market portfolio, or this would be the same amount of risk as the market portfolio. Then you have stocks, shares with betas less than 1. So they're less risky than the market portfolio. So less variable than the overall market. And hence sometimes people refer to these, as you can see, as defensive stocks or defensive securities. What you also have are some individual stocks, some individual shares, which have a beta greater than 1. That means that they're more variable than the market portfolio. So they're riskier than the market portfolio. And again, sometimes people refer to this as aggressive stocks or aggressive securities. So there's another model, there's another bit of theory that maybe helps us a little bit in this puzzle of what determines stock returns. But it doesn't, and I didn't promise at the beginning, though everybody didn't leave, it doesn't give us a complete answer. But there are a few suggestions by different authors of ways in which we can use this idea of CAPM, or generally this idea of identifying unexpected return. The first suggestion, though I'm not sure it works perfectly, is that we could use that notion of CAPM, the capital asset pricing model, to generate a required return. So what we require, given the amount of risk involved. And we can see that very clearly in terms of that idea of the risk premium. So given the amount of risk involved, then this is what my return, my required return would be. So it explicitly takes account of risk in that sense. And then the suggestion is that maybe you can look at individual stocks or individual shares to see whether the actual return is lower than higher or higher than what you require. And therefore the suggestion that maybe you can identify overvalued shares, more importantly, undervalued shares, and maybe act on this identification. So that's a suggestion. What it involves usually is working out that notion of return to start with. So you've got your required, but our actual is usually really an estimate. Because go back to what we started today, we're looking forward in time. So we're here now, we're thinking about buying a particular share. The return we get will actually happen in a year's time. So usually you need some sort of model in order to say, well, this is the return that I'm likely to get from this particular share, and this is what I'd require, given the amount of risk. So not as simple as might be suggested in terms of some things you might read in this area. Again, not the central focus of today, but I guess this is the principle, even though the model might be slightly different, to this notion of chartism. So what you're doing is you're plotting and seeing where you think the return or the share price will be in 6 months or a year's time, and comparing that to your required return, and then maybe saying, right, this is a good bet, we're going to buy it. Well, there's lots of argument, lots of debate about whether that actually works in terms of generating, on average, any additional return. So that's the first suggestion. The second, again, not a complete answer, is that maybe the return that we generate there, which is essentially another interest rate, so I think this goes back to your question earlier, yes? The return that we generate there, which is an interest rate, is maybe a lot more appropriate to include in our kind of present value models. Because now we have a return given the amount of risk involved. So if the risk is very high, then the return would also be commensurately higher. And that would be appropriate if we were trying to value this particular company, given it's very risky. Another company, the risk may be very low. And hence the required return, as far as CAPM is concerned, would also be that much lower. Trying to value that company, less risk, then we'd expect to have that lower interest rate figure. So that's the second way in which it's suggested you can make use of those ideas behind CAPM. I suppose, again, coming back to one of the earlier questions, it's also suggested that you can use this expected return in investment appraisal, in capital budgeting. So, as long as you have something which is in the same risk class, so even though it's a new investment, it's similar to something that's gone before, which was roughly this risky, again, you can use your expected returns based upon the capital asset pricing model. So various different ways in which you might be able to use these ideas. Though none give you a notion that you can accurately identify what a share price or a return should be. It just isn't that simple. And my final slide, if I actually get to it, will hopefully illustrate that a little bit more. Right, now, where do I want to take this? Right. So that was in terms of some theoretical ideas. The other thing I wanted to do today was just say a little bit about how people try to operationalize these ideas. Again, that picks up on a couple of questions that people are asking. The place I want to start in terms of operationalizing is the notion of CAPM. But I also want to use that vehicle to suggest or put forward a few other arguments in terms of other factors that may influence